All right, we have one more topic. So let's assume you're driving to work one day and a car coming in the opposite direction fails to see the stop sign. Okay? What happens? Car slams into you, absolutely destroys your car, and the only thing that's left is the hubcap. Everything else is gone. All your work tools in there, your computers are busted up, everything's gone. What type of tax possibilities exist to help you out? Of course, casualty loss. That's the topic we're going to cover right now. Just to let you know, we're in a studio with props, and so we're trying to figure out how to do some fun things to sort of break up the day. So I hope that helped a little bit, and we've got more for you later on. All right, we're looking at what's referred to as a casualty loss. A casualty loss is a deduction that you get to claim for something that is a casualty, and casualties can be of a number of different topics. I'm going to do a bullet point after I go through this one form. This is probably a form that you don't see a whole lot of for a couple of different reasons. But when you have a casualty, being an accident, a theft, a fire, a storm, a shipwreck, anything like that, that's really not reimbursed for insurance a lot, and you say, wow, I've got to be able to do something with this loss. Can't I deduct it? It's this form that you need to go through. This is one of those attachments. And basically what they're going to ask for is tell me about what happened. You know, tell me about the property, A, B, C, or D that you have. And they're going to ask you, what is the cost of the property? Did you get insurance reimbursement from this? Okay, which is an important aspect. What is not reimbursed for by insurance? And then, you know, as a result, did you get a gain or a loss from this? And then what was the fair market value of the property before the casualty? What is the fair market value after the property? And then you're going to be comparing the decrease in value with the net amount of the loss that you have up here. You enter the smaller of the two, and that will give you your casualty loss. Now what's important is that from each casualty that you have to do two things. One, and I'm not going to go through the form anymore, but this sort of walks you through the pieces. You have to reduce each event, an event being classified as something that occurred, a theft, for example, by a floor of what we call $100. And then after each event, a casualty, a theft one day, maybe a flood another day, after each event is reduced by a $100 floor, you aggregate all your losses for 1 year together, and to the extent that they exceed 10% of your adjusted gross income, you get a deduction. Here's what it looks like as far as the main key points. Okay? Casualty loss, typically we'll see fire, theft, storm, shipwreck, or what they call other casualty. Okay? So those are the big ones that you have. Your deduction effectively comes to the decrease in the fair market value of the adjusted basis net of any insurance reimbursements. And then it's the $100 floor per event, and then it's the 10% of your AGI threshold. And that, if you think of a typical person that might have, say, a $50,000 AGI, well, 10% of your AGI, 50,000 times 10, $5,000. You know, how much did you lose? 2,000. It's like, can't deduct it because it didn't exceed 10% of your AGI. So a lot of these casualty losses. You know, I had this happen to my above ground swimming pool. There was a big, storm that came and it wiped it out, and the insurance won't cover it. How much do you lose? $2,000. It's like, can't deduct it. So what happens is that threshold of 10% is a huge one for a lot of companies or a lot of people to get over. But it's been a tough couple of years for disasters across the country. And so what I wanted to do is talk about the federal disaster area, the new rules that are in place. This is something that came about for the 2008 year. But there's something that we had the old rules with disaster areas. Typically, if you had a casualty loss in any 1 year, let's say something happened in the 2008 year for the taxpayer, a major catastrophe, and the president came on television and said, I declare this a federal disaster area. Now, for those folks, that was important because it put feet on the ground money out there to help those people out, federal monies to get them over those disasters. We had Katrinas, we had the wildfires, we've had the floods, we've had a lot of different things going on in the country. And that's one aspect of it, is putting money out there to help these people. The other aspect is that when the president declares something a federal disaster area, you can take the loss that you incur, say in 2008, and carry it back to 2007. What that does is takes a loss out of one year, puts it in a previous year, allows you to file an amended return for that previous year and get some cash immediately right away. So you have that option of doing it. But they added one more option this year under some new rules. Number one is that if you have a casualty loss this year, rather than making it an itemized deduction, which is where we're seeing it right now, your casualty loss can be added to your standard deduction to give you an additional benefit. So that's a new change. That's a new rule. That might be a testable area, is that casualty losses can be added to your standard deduction. And also that if you have one of these federal disaster area losses, that it is not going to be subject this year to 10% of your adjusted gross income. So there'll be no threshold that you have to get over of 10%. And again, this is if it's a federal disaster area casualty loss.